recording our special recording given the unprecedented banking information and events of the last week. We just want to take some time to maybe go through a little history of banking, what's occurred over the last few days and weeks, what actions maybe the Fed has done and what's to come in the future. And then more importantly, what do we do given the circumstances? So David, let's start with maybe a little bit of history of banking and how it's worked and works.
Sure. I think, banking has been around for a long time, but really it's a system that's summarized in, one statement, which is it's a system that's built and only operates on trust. Historically, it was used when, people would go to war, they would leave their valuables with somebody that they trust. They were also used to facilitate trade between countries. So there's a number of different ways that banking has historically been used. A lot of that has been tied to agrarian type of economies, and basically is also where insurance originates from as well. So really transfer of risk, store of value, and then a medium of exchange is what money is, and then banking systems facilitate that. As we kind of look at it, as you look at any bank, if there was to be a run on any particular bank, as big as JP Morgan or as small as some of the regionals you may have heard about, it's very, very difficult to withstand because of the amount of capital and the structure in the banking system today. But Jared, I don't know if you want to talk a little bit about kind of some parallels that we've seen in other times in history that kind of look like what we're seeing today.
Well, and David, on the trust topic, you have the dollar, US dollar, right? We used to be under the gold standard, which meant every dollar that was issued was backed by physical gold. It wasn't a trust system. It was fully backed. We went off the gold standard, and the dollar's been on the trust system all these years as well. All right, so banking is very similar to that. And when you look at history, there have been shocks of interest rates going up. Today's the anniversary of the Fed starting the interest rate hiking cycle 1 year ago, right? They went almost 5% within 1 year, from 0 to 5. And there were likely going to be consequences to that action overall. But again, it's not unique that we've had those large increases. And when you look back to the 70s and 80s, that was the last time where you really had a major shock occur. And during that period, everybody knew that the majority of banks were insolvent in the 70s and 80s because the investments they bought, whether it was made loans or bought bonds from the late 60s, early 70s, those bonds were severely underwater as interest rates went up. So if they had to mark that loss to the market, it wiped out all the capital of the banks. So they changed the accounting rules a long time ago to let banks have those assets that were underwater, hold them to maturity, meaning they don't need to mark down the loss. And that helped banks navigate through the ups and downs of interest rate cycles and allow for the trust to remain within the system, right? And we've seen that in the 70s and 80s. And that's really what's unfolded this time around with Silicon Valley Bank kind of starting this in a big way last week. They took in a lot of deposits and they bought longer dated, mostly treasuries and mortgage-backed securities. So it wasn't that they had any bad assets that they purchased, it was just the duration. And as the Fed raised rates, it created a lot of paper losses. And then as some of their clients needed money to fund their businesses over the last number of months, as the tech startup have gone from generating a lot of cash flow to needing cash to fund the businesses, it really put a run on some of the assets needed to liquidate. And that's really a lot of what's unfolded the last week. And when you look, the other cycle to compare to is 08-09, because what we're all looking for is what's the playbook the Federal Reserve is going to use and the FDIC to deal with a lot of the banks and the financial stress in the system. And when you go back to 07, there was cracks in the system, right? A lot of that is a different period because the loans the banks made were bad loans, right? And those assets back then were a lot of the mortgage securities, housing prices were down, and there were a lot of assets that literally had no value that were being rated AAA. So the assets evaporated quickly, which wiped out the capital, and there were a lot of forced mergers, right? If you look through 07, Countrywide was forced merger into Bank of America. The big one that kind of started things was Bear Stearns into JP Morgan in March in 2008, or 2007 rather, where I guess it was 2008. Trying to remember back, but at the time, if you recall, Bear Stearns, JP Morgan paid $2 a share for Bear Stearns with the backing of a lot of the risk that Bear Stearns had on its balance sheet. Ultimately, they were able to give it a little bit more time. JP Morgan ultimately paid $10 a share, but there was stability within the financial system. And then 2008 played out where banks ended up raising a lot more capital between April and May of 2008. And the S&P actually made an all-time high, which is hard to believe, May of 2008. But then that played out into September when the Lehman Brothers, and this weekend was slightly reminiscent of the Lehman Brothers weekend, where Sunday night in September, Barclays was scheduled or looking to buy out Lehman Brothers. But there wasn't enough of a backing like the Fed had offered Bear Stearns and JP Morgan. So Barclays backed out of the deal, and it went from a Barclays merger of Lehman, buying out Lehman, to a bankruptcy. And that's where things have unfolded. Now, fast forwarded to yesterday, they were looking to find a merger for Silicon Valley, but nobody would offer. So I'm not sure if the guarantees weren't offered. Because in this case, it sounded like PNC was looking to buy them. So ultimately, the Fed went with this deposit guarantee, right? And what it's done is all the people that have deposits are safe, but then what does it mean for the shareholders? What does it mean for the bondholders? What does it mean for the preferred holders of the banks? And not specifically with Silicon, really for the rest of the regional space. And that's what the Fed has left a lot of unknown, which we're seeing today with a lot of volatility in some of the regional banks. And that's some of the challenge facing the markets very short term.
Yeah, so Jay, I think some of the differences, as you kind of compare, 2008 and 2009, the 70s and 80s and today, this is an environment that looks a lot closer to the 70s and 80s than it does 08, 09. And that's just because of the rise in interest rates and it's safe bank assets. So capital that banks are required by regulation to keep on their books, typically in treasuries, right? But because of that record increase in interest rates that we saw last year, you saw that the price of those assets has come down. And then really the uncertainty, which has fueled a lot of the drop in stock prices of banks that you're seeing today, particularly in regional banks, the larger national, more systematic or structurally significant banks are less impacted. And you're going to see the Fed is going to have to come out and take more action to instill confidence in the system, because that's really the one tool that the banking system needs. And there are a number of ways that they can do that, and they're ultimately going to have to do that. One of those ways is to create a facility that could accept these deposits, of these treasuries, for example, that they could then exchange it and get their money out at a later date. And, as we look at COVID and some of the things that the Fed has done, when the Fed really has something in terms of in their focus, which is financial system stability or reinforcing the overall economy because of some kind of a structural risk, whether it was the financial crisis in 08, whether it was COVID and some of the other things. During COVID, we saw that the Fed came out with some facilities, as high as like $500 billion or $1 trillion available for certain types of loans. They didn't use any of it, right? They used like $2 billion out of $500 billion in the municipal side, but that was enough to kind of stabilize the system. So again, it's really just based on trust and knowing that the Fed is going to be there. But you think about what the impact is on the overall economy and some of the smaller banks. You need a healthy banking sector, a healthy financial system, not just on the upper end, which is some of the larger national banks, but on the regionals as well. They drive a lot of innovation. They're the ones that are typically paying higher fees on deposits, which is why they had assets at those banks to begin with. And they are the ones that really finance the smaller end of the economy, which is the majority of the economy. The majority of the economy is not the S&P 500. The majority of the economy is small, micro cap and small companies that are the backbone of the U.S. economy. And really you need to protect those regional banks, and the Fed's going to have to come out and basically put in a significant amount of effort and be more or less proactive to the extent that they can be now to prevent issues going forward. But as that's being worked out, JR, this is an area that we definitely are looking to reduce any exposure on, because like with any sector or really with any company, there's going to be opportunity. There's going to be opportunity to make money. And you're seeing that a lot of the bank stocks have already bounced back quite a bit from this morning. Some were down nearly 50 or 60%, are now down 5 or 10. So that's significantly improved. But at any moment, as panic sets in and somebody tries to pull money from any one bank, it makes the future of that bank very uncertain. And so as a good risk mitigation tool, reducing exposure there makes sense. I think the other thing that's worth pointing out is it's an area that we don't have a lot of exposure in the first place. And because of just the amount of diversification that we have, none of the positions that you'll own through a managed strategy are going to be, higher than 1% probably at most. And so in that case, again, your losses are very, very limited.
Well, on top of it, we had no exposure to Signature Bank or Silicon Valley Bank, or any of the direct challenges out there currently. And when you look at the mistakes of the Fed the last number of years, the thing that seems different from 07 to 09 and today is just the speed of information and how quickly things flow, right? It was fast back then, but it's another level today. And having the second largest bank failure happen in 48 hours it kind of shows that overall how quickly things can occur. And the Fed needs to be quicker on stopping this overall and having the facility. So what they announced with the deposit guarantee is opening the discount window to offer assets. And like you said, David, part of the challenge is Silicon Valley bought treasuries a year ago that paid less than 2%. Interest rates have gone up. So the value of that bond they bought paying 2% fell to 85. So it's down 15%. If they hold it to 10 years till maturity, there's going to be no loss. But as deposits came out, they had to sell it for a loss to pay people off, and that just undermined the confidence. Whereas as the Fed steps in and says, we'll take that off your balance sheet, give you the 100 cents on dollar cash and let you work through it, that's what they're offering now. They needed to do that last Thursday. The 48-hour time frame was just too slow overall. And now as you look forward and you look at some of the history, because again, what investors need now is a model for how they're going to deal with the bank challenges ahead. And when you go back to Washington Mutual, again, another JP Morgan merger a long time ago, the stockholders got wiped out, the bondholders got wiped out, the preferred holders got wiped out. And you took all the operations of Washington Mutual and you merged it into JP Morgan basically overnight, right? And that's kind of the extreme of wiping out. When JP Morgan bought Bear Stearns, everything was backstopped. The preferreds, the bondholders, the equity was basically wiped out, but ultimately got $10 a share. So those are kind of the two extremes that have been operated versus the full bankruptcy option that Lehman Brothers were. Here, they used a model that they didn't use for the most part in 08, which is to just do a deposit guarantee. But you've left all the other shareholders or bondholders not knowing what the model ultimately is going to be. And that's what's kind of impacted the regional bank, is just the unknown of how to deal with this. So as we look forward, the Fed, as you said, David, could open more of these facilities, but you've already had the market price in that the Fed's not going to raise interest rates next week, right? We were talking a week ago that they're going to raise as much as 0.5% or even 0.75%. Now the market is pricing in no interest rate hike, as well, because when you're in the middle of a financial system kind of crisis and some of the regional banks, it's hard to raise interest rates despite the fact that CPI comes out tomorrow and PPI and inflation could be higher. So the other things to look forward to is pausing on interest rates and then ultimately maybe having to cut. You're going to see the balance sheet runoff maybe pause and then ultimately have to maybe provide more liquidity or print more money in the system, right? These are things that could happen because, as we've always said, the Fed has a dual mandate, which is full employment and stable prices. But we've always argued since the financial crisis that there's a third mandate, which is financial system stability. Because if you don't have financial system stability, like you said, David, the regional banks, small business is the growth engine, the job growth engine of the American economy. And if you don't have money going into that area to fund it and keep that growing, you're not going to have labor market growth and prices are not going to be there. So if you don't have financial system stability, you cancel the other two out. And right now, that's what the Fed has risked with not pausing, moving a little bit too aggressive over the last year to just give time for the system to work itself out. But what we're watching for is more aggressive action, and those will be the most likely scenario you'll see out of the Fed, maybe even as soon as this week or the weeks ahead. But again, let's talk about maybe some of the opportunity that's out there, because crisis investing, as we've talked about it many times over the years, you want to mitigate risk in the short run, but these big swings do offer a lot of opportunity. So maybe that's some of the stuff we're monitoring here, David.
Yeah, well, I mean, as far as opportunity, we saw the rates across the yield curve really come in significantly today, right? Because of the concern. So what does that mean? If we're reversing this trend of rising interest rate, well, what are all the things that we've been talking about that have been suffering last year, for example, because of rising interest rates, right? So one of those is real estate investment. We saw that slow down, and with lower rates, you could see a pickup in real estate activity, whether that's commercial or residential. Again, just a week ago, we were talking about 7% mortgage rates. Now those rates are improved. So maybe people take advantage and are a little bit quicker to move on that. You have growth companies where valuations are impacted by long-term rates. We've seen those come in significantly. So again, if that pauses, growth companies could be positioned to do well, in a growth versus value type of a conversation. So there's a number of different things to kind of look at. And I think more importantly, if the Fed kind of pauses here with raising interest rates, because again, a lot of that is yet to be felt. The Fed has come out and kind of said that a lot of the actions have yet to be felt. And so we're still catching up and seeing what the impacts are. But if we're already at the terminal rate, the interest rate the Fed expects to get to, or maybe slightly above, if there's potential rate cuts ahead, there's other opportunities as well as, and just overall economic activity when you typically see shorter term rates that are lower than higher term rates. So you get back to a normal yield curve potentially. And there's, a number of areas, whether, like I said, it's tech, anything tied to growth in general has an opportunity. And then at some point, like in the financial sector, there'll be winners and losers as well, because any of the times that we've seen larger banks take over some of these smaller banks, sure, they've gotten some assets. And like you said, JR, in many cases, equity holders and bondholders may have gotten wiped out from the bank that was being taken over. But the larger banks in that example made a lot of money through absorbing operations at very, very discounted cost and buying assets for 30 or 40 or 50 cents on the dollar with a full backstop of the government as well. So the backstop is important to facilitate the transaction, but it's not one that costs the taxpayers money, and again, creates opportunity in the market.
Well, on that topic, David, in this case, when you have the Federal Reserve has always been the lender of last resort, right? So when you look at, is this a bailout to guarantee depositors, or it's a crisis? You need to stem it and bring confidence back. No question about the action they took. Now the question is, what do you do ahead? Because clearly, with some of the regulatory changes, Silicon Valley kind of flies under the radar a little bit more as opposed to some of the bigger banks. So stress testing the investment portfolio, for example, on what kind of duration risk is in a portfolio. These are some of the changes that are going to come. But meanwhile, when you look at investing in the financial sector right now, you really have to stay toward the top 10 banks, because number one, they're going to be the beneficiary of the weakness in the regional, because people are just going to go for safety in the short term. And it's just kind of that too big to fail mentality that companies, individuals are going to want to move their money to where they're safest, despite the fact that deposit guarantee has been hinted. I don't think it's clear enough. I think the Fed needs to be more forceful on what it means to the average person, that there is no loss of deposits. All deposits in every single bank are guaranteed for the foreseeable future. Some phrase like that to really bring the confidence back overall. But it's really hard to invest in the regional and small bank in this environment, despite the fact that it's very profitable in the cycle we're in, and there really aren't a lot of losses. So looking at the landscape, as shocking as some of the events have been the last week, it is time to be patient, look and reassess, and we do that as always. But there is going to be, and there is opportunity in this environment. Depending on where interest rates settle, what the Fed ultimately does, there could be a move back to growth stocks, for example, because with lower interest rates, that supports higher valuation as well. So we'll see how these conditions persist. But with that, we want to kind of thank you for tuning in to a quick background and some thoughts about the market, and I'm sure we'll be in touch very soon.